Hello, welcome to Any Answers Answered for December 2019. This month we have two questions, as usual, from the pages of Any Answers, and the first comes from Hazy, who has a question about the employment allowance. A fairly simple question, I think. Having not qualified up until month 8 of a particular year, they now do qualify for the employment allowance, and the question is being asked whether they therefore get a share of the year from month 8 onwards, or do they get the whole £3,000? The problem that Hazy highlights is that the revenues guidance seems to say one thing, where his software seems to be telling him something else. So, Tim, who's right, the software or the revenue?
It's a very interesting question, and in fact, reading a little bit between the lines, Hazy's, I thought initially it was Jay-Z, but Hazy's client was initially disqualified from the employment allowance of £3,000 because for a few years now it's not been available to a company, for example, where the company is secondary contributor in respect of only one employee, and that one employee is a director. So in common parlance, as it were, we're looking at initially a one-man, one-woman band company and not eligible for the employment allowance at all. Mm-hmm. But then they take on an employee or two or three, and that does then qualify them for the employment allowance. And as you said, in month 8, they take on an employee. Well, from that point on, yes, they qualify for the £3,000 employment allowance. And the first point to make is that there is no apportionment of it for the year. If you qualify for the tax year, by virtue of it not being, in this case, a one-man company for the whole year, then you get it for the whole year. So 3,000 is available, is the first point.
And so, sorry to interrupt you there. So my brain is then immediately thinking, well, there's an opportunity here.
Yeah, you bet.
At the very end of month 12, I might suddenly think, well, let's find an employee
exactly. If you
to
were,
get my 3,000.
If you were to take on an employee at the end of month 12, you would be eligible for the 3,000. But it leads us to the second question, which is if the £3,000 exceeds the secondary class 1 contributions, because remember it's a credit against the secondary NI, if it exceeds the secondary NI for, in your planning scenario, month 12, can we do anything with the excess? In the question on accountingWEB, it was month 8, so maybe in months 8, 9, 10, 11, 12, there would be at least 3,000 of secondary class 1 against which we can set it. For certain, you can't carry any unused forward, so there's no question of carrying it forward to a later year. But my reading of the legislation is that you can set the 3,000 against the total secondary NI for the whole tax year. And so even though you only become eligible in month 8, you could actually offset some excess of that 3,000 against the director's secondary NI in months 1 to 7, although you would have to write to HMRC because your payroll software, as Hazy has discovered, won't allow you to do that. You would have to write to them to ask them to credit you and refund that excess secondary that you would have paid.
Right. So the key answer for Hazy is that yes, you get 3,000, not 5/12 of 3,000.
Yeah.
But perhaps more interestingly, if in my example you had done it in month 12 and you'd only had £100 of employers NIC that month, you might be thinking, well, I can't get the full use of out of it. But actually you can, as you've explained, by contacting the revenue and saying, well, actually we're going to set it backwards in the earlier part of the year. Potentially a very useful tip.
I do just have a rider to your planning point. The idea that taking on maybe a very junior, low-paid employee in month 12 in order to get yourself to 3,000 would trigger, I forget it and I've not looked it up recently, but there is a general anti-avoidance rule which has always been there in the employment allowance legislation. If an employer does something just to get the employment allowance, they don't get it. So your month 12 idea of taking on an employee just to get the allowance, you wouldn't. However, if you're going to take on an employee anyway, then taking them on at month 12 rather than month 13, aka month 1 of the following tax year, would be a good idea.
£3,000 worth of a good idea. Excellent. Our second question this month is from John Stone, who asked a question about the introduction of a partner. Husband-wife partnership proposed to introduce an employee as a partner. A reduced profit share in these circumstances would constitute a disposal for CGT. And then John asks, am I correct to assume that business gift/holdover relief could be used to defer this gain? Suppose the new partner is entitled to a future profit share, but not a share of the existing capital of the business. Does that mean that in fact they have not sold anything and therefore there's no CGT? Let's do the first question first. Can you have business gift holdover relief in that situation?
Well, this is a far more complex area than the questioner seems to appreciate at first sight anyway. Partnership capital gains tax is something that I used to talk about a lot in lectures, and you've done as well. And the difficulty is that the Taxation of Chargeable Gains Act 1992 is almost entirely silent on partnership capital gains, and instead we have to rely on long-standing practice and revenue guidance in the revenue manuals. And one of the difficulties that arises in practice is what happens, and I'll open this up to a more general point because this is just a specific instance of a general point, what happens when the capital asset sharing ratio of the partners changes? And the answer will depend on whether the assets in respect of which partners have capital asset sharing fractions are revalued or even reflected in the accounts of the partnership. And perhaps I can illustrate this by using our own partnership, the professional training partnership, which has been in existence since, if I remember correctly, 1990. So we're coming up to, I suppose it'll be our 30th year next year. That partnership has never reflected goodwill in its balance sheet, first point. When a partner joins the firm, the way in which we've always dealt with that is that the existing partners have a reduction in their capital asset sharing ratio, and the new partner enjoys a share of that, which effectively means that if we took on a new partner on the 1st of January 2020, you and I would have our capital asset sharing ratios reduce, the new partner would have an increase. Now, that technically constitutes a disposal by you and me of, and the other partners, of an interest in the partnership, which would trigger a capital gains tax, potentially a capital gains tax liability, but it doesn't unless we've revalued the goodwill in the balance sheet, which we haven't done. And so the new partner simply takes on that share at a zero cost, of course, but you and I don't in fact have any actual disposal to worry about. And that, I think, covers the situation that they're in here. So there won't be a capital gains.
So the point is we are introducing that person as a partner. They are picking up a share. Yeah. It's just that the share that they're picking up is nothing. Because
and even if there was a payment to the existing partners outside the accounts, so an incoming partner pays, let's say, £10,000 in respect of their share, that payment is disregarded for capital gains tax purposes unless it's been revalued in the accounts. And that's the key point. And I can remember some years ago, we were talking about a case where an accountant, in fact, had valued the practice goodwill. He was a sole trader, valued the practice goodwill at 300,000 in order to assist with raising a mortgage. And then a couple of years later, he admitted a partner to his practice, but without disclosing a capital gain. And it's that occasion, not the revaluation, it's the change in partnership asset ratio. Anyway, enough said, it is a very complicated area.
But if they were recognising the goodwill, there would be a gain, and it would be a partial disposal of the overall goodwill by the existing partners. But in the example that we have before us, there simply isn't a gain. So it's the easiest holdover calculation you'll ever do, in that there's nothing to hold over. Hopefully useful. Tim and I will be back after Christmas and the New Year break. I hope everybody has a wonderful Christmas and a very happy New Year. And Tim and I will see you in 2020.